Coming up on Market to Market, the latest government guess has producers and analysts talking. We break down the numbers with our blue ribbon panel: Naomi Blohm, Elaine Kubb, Don Rose, and Darren Newsom. Next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, March 31 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. We're going to keep with our tradition of breaking down USDA's prospective planting and quarterly stocks reports with a blue ribbon panel. We've assembled many viewpoints to help better understand the numbers presented. But before we discuss, let's set the table with this week's market closes. Trading was limited ahead of Friday's report, with much of the action coming during the final session. For the week, May wheat gained 2 cents, and the nearby corn contract improved 8 cents. A record high estimate for soybean acres pressured the trade Friday as the May contract dropped 30 cents. May meal decreased $9.80 per ton. In the softs, May cotton condensed 14 cents per hundredweight. Over in the dairy parlor, April Class 3 milk futures improved 30 cents. The livestock sector retreated from its bull run as the June cattle contract gave back $1.97. May feeders fell $1.10. And the April lean hog contract shed $1.60. In the currency markets, the U.S. dollar index gained 78 basis points. Crude oil rebounded to add $2.63 per barrel. COMEX gold declined 50 cents per ounce, and the Goldman Sachs commodity index put on 10 basis points to finish the week at 388.55. It is against that backdrop we start this discussion. Here now to lend us their insight are four of our regular market analysts. Joining us are Naomi Blohm, a market advisor for Stuart Peterson; Elaine Kubb, an analyst and author of the book Mastering the Grain Markets; Darren Newsom is DTN's senior market analyst; and Don Rose is the founder of U.S. Commodities. Welcome to all of you.
Thank you.
Before we get started, you can listen to our market discussion anytime by downloading our market analysis podcast on our website, iptv.org/MTOM. All right, folks, we had an eventful Friday, today, March 31st. Things came out in the news. Darren, I want to start with you. As our native Kansan, wheat really saw, I suppose, the least surprising numbers coming out of this report. First and foremost, what are your thoughts on these prospective plantings and quarterly grain stocks?
Meant nothing to wheat at all. We knew going in, winter wheat had lost 3 to 4 million acres. That's the guess right now. We knew going in, we had a lot of wheat on hand. Quarterly stocks showed that. Now, the only interesting thing that I pulled out of this for the quarterly stocks is that wheat came in maybe about 30-some million bushels above the pre-report estimate. If you carry that out through the last quarter, looking at average demand, you're going to add 50, 60 million bushels to the bottom line. That puts us back over 1.2 billion bushels of ending stocks. No shock there, because we haven't been running on pace with USDA's exports anyway. So, it's kind of a pie in the sky estimate that, maybe we're going to have ending stocks to use around 48, 49%. You make that adjustment, it's back up to 56%. Wheat's in trouble. I mean, it didn't change, today didn't change anything about wheat, just reinforced the idea that we've got a lot of it.
But it was green on the day. Was that just spillover support coming from strength in the corn market?
No, it's just because it didn't matter.
Okay.
I mean, wheat's been beaten up for a long time. Both July contracts of Chicago and Kansas City were down near contract lows. No reason to push them to contract lows. Traders are already short into the week, into the month, into the quarter. Cover a little bit of the short positions, wheat goes up.
All right, Elaine Cub, as you look out over South Dakota and North Dakota in your travels, that decline in wheat acres, especially on the winter side, that didn't shock you very much, did it?
No, absolutely not. That spring wheat, you know what was interesting, you guys mentioned in the lead up that the soybean acres was really the notable number. We have this record large soybean acreage intended or expected, and that was coming from the wheat acres. And when you look at the states that are expecting to increase notably their soybean acres, it's the wheat states. It's Kansas, Oklahoma, the winter wheat states. It's North Dakota, Minnesota, the spring wheat states. So just geographically, that's one little subtlety from the wheat planting number. But number-wise, total-wise, Darren's absolutely right. It was not a surprise to the market.
At the end of the day, Naomi, we are sitting on a pile of wheat in this country and globally, as Darren has talked about. Little pop this week. How excited should a wheat producer be watching this little bounce?
I wouldn't be overly disappointed going forward, and I would say that if there's any weather issues along the way because of the reduction in acres, wheat will get a bounce along the way. But to the conversation, the global supply is still large. The rallies need to be opportunities to lock in sales because it will take a devastation to the crop in order to see a significant rally, just because there's so much wheat around the world that is available anywhere around the world at any time.
Significant rally. As we look at the Chicago wheat, let's use that as our benchmark, is $5 in the card, Don Rose, in your opinion, at any point in this next growing year?
Well, weather's a great equalizer, and I think, anything's possible. But I think when you really look at the report, we're talking about the numbers. But really, it was more important to look at the reaction, because we went into the report with corn, the second largest short ever in history, going into a planting in acres report. We had wheat, the fifth largest short, near a record short, going into a huge report. And so when we had numbers that looked like they were a bit positive, a bit negative, 270 million bushel stocks in all positions over a year ago, the market did not have any more selling left in the market. The bears had come out of the woodwork. So you had some technical bounces. Overall rally, short covering rallies are marketing opportunities. The real question, can you get to $5? I think you have to get to $4.60 on July wheat before you can talk $5. There's just big supplies out here. And the thing about the report, our feed wheat usage was disappointing in this report, and that's a bit of a negative.
What was driving that, do you think? I mean, why are producers just looking at cheap corn and they're not feeding wheat for that reason?
Yeah, I think the big problem is like the acres. I mean, everybody around the world is fighting for something that's positive, and I think the demand on the overall feed demand is just really a fight situation. You feed corn, you feed wheat. There's a lot of alternatives out here, and that's the real issue.
All right. Darren, final thought on the wheat market. Did this little bounce, did this nothing burger of a report encourage any technical changes in the wheat market, either short or long term?
Does a 2-cent rally ever change anything technically? No, it didn't change the market. I mean, the only thing we can say is that both July Kansas City and July Chicago, they held their contract lows. Does that mean they're going to go back up to the highs? Most likely not, because we're still dealing, like I said, if we look at the old crop market, we're still dealing with 56% or something like that ending stocks to use. Still, roughly, if you just calculate even losing however many acres we're going to lose, because we have no idea after today, but how many acres we're going to lose, we're still talking about almost 1 billion bushels of ending stocks for 17-18. That's not going to get the market excited except for short covering.
All right. Well, let's see if we can find some excitement here in these reports. We'll leave beans for just a little bit later on. Let's talk this corn market first. We did see a little pop in the corn market today. Again, well, let's look at the new crop, December corn. Acres were down a little bit more than the trade expected. Elaine Cub, when you saw that number print at sub 90 million acres, 89.993, whatever it was that a shock to you?
Not at all. Let's call it 90, nice round number. If we have good planting weather, which we are likely to have, it'll probably end up being 90 or more. It was not a surprise to me, and it doesn't change much about the fundamental supply and demand of the markets. If you project this out into the 2017 year, sort of imagine that we have another good yield, you're still looking at a stocks to use ratio in this next marketing year of 15% or more. So you're going from a 15.6 stocks to use ratio down to a 15% stocks to use ratio is basically not a change. We still have a scenario with lots of big corn piles everywhere that you can pile corn, everything full of corn. Nobody's running out of corn. So I think we are in a fairly low price scenario for the foreseeable future.
Okay, Naomi, you look like you
Disagree.
got some thoughts.
Disagree. I think that the market's going to have the ability to work a little higher. I think we retest last summer's highs. Statistically, we've done research at our office that shows when you come out of a record crop, the following crop year, this percentage change in price is a 70% swing on average. And we've actually put statistical math to it to show that we have 70% odds of seeing the futures price get up to the 450 level and retest last summer's highs. Now, we don't have a reason to go higher than that unless the weather comes into play. But if you take today's number for planted acreage and do the math on what the harvested acres number can be, if yield is trendline at 170, ending stocks drop down to 1.8 billion bushels. And that's a market price that keeps us in the range that we've been in, which keeps us into that point where we can retest that 450 price high area. Now, if yield comes in at 165, then you got a different scenario. You've got ending stocks that come in at 1.5 billion bushels, and then you're talking $5 corn. So weather is so important this summer. We're going to trade every weather rally that comes along the way.
Now, you mentioned the yield coming in 170, 165. So this 450 or $5, are you projecting that as the futures price at harvest with a sustained weather event? Or do you think we'll see it like last year where we get a scare, yield could drop to 70, 165, pop it up to 450, and then it trades back down?
Great question. It would be the summer scare perception to get the market to go to those futures high prices.
Okay.
And then we'll see what actually yields as harvest comes.
Gotcha. So really the distinction is, Elaine, when you look out and you project another big crop, we're still sitting on ample supplies. Naomi, your thought is with reduced acres, perhaps, or a weather scare somewhere, get some folks excited. Now, Don, you mentioned, or sorry, Elaine.
I just say, for the record, I hope you're right. But at this point, we don't have a reason to know that there's going to be a big weather scare. You know, the long-term forecast is for normal weather. So hopefully something happens. I'd love to see 450, but yeah.
All right. And so, Don, you mentioned coming into this second largest corn short in history on a report day?
Yeah, and that's the thing that you have to look at is these funds come in and out of this market just very quickly, and they can change the dynamics very fast. That we just came off a position that they were long, pushed down, 25 cents in short order. But I want to back up and talk about the real world supply of grain. It's just the opposite of last year. Brazil, corn is probably 1 to 1.2 billion bushels larger than a year ago. The Argentine crop's probably 350 million bushels larger than a year ago. A year ago, we had the crops in South America getting smaller, and now we have them getting bigger. We have ample supplies. So to have a weather scare, we can easily have a weather scare. 80% of the market is weather. But I think realistically, to be fair, you have to realize you're going to have to chew through big supplies before you get to the weather scare. And that's probably why short covering rallies are more sells than buys until you can turn into a realistic situation that is a real weather scare in an El Nino year. So it's possible, after the 4 good years of crops, we're due. Is this the year? Don't see it so far, but it could be. But we just have a big buffer out here that we have to remember.
It's that buffer that's what's making us think twice here about getting excited. Darren, we're dancing around the question. December 17, new crop corn, post-report. Do you market aggressively or hold on and wait for a weather event?
Well, I'm going to step aside from that question and let's talk about the number that really matters.
Okay.
Let's look at the quarterly stocks number because, like everyone's pointed out, basically the acreage number is kind of like a bedtime story. It's nice and fanciful and fairy tale, but there's so many things that has to happen, it really doesn't exist. But the quarterly stocks number actually did exist, and what it showed is that first half demand was not as strong as what we thought it was by about 150 million bushels. So guess where that goes? On to ending stocks again, which goes back to what Don was talking about, which was this huge buffer that we have. So if we actually push, if this comes to pass, and we see USDA reflect this as well, Brazilian corn starts working into the system, Argentine corn starts working into the system, we start to see our exports and other demands start to slow down, we could be looking at an upper 2.3 to 2.4 billion bushel ending stocks number for old crop corn that carries over into new crop. And then all of a sudden, 90 million acres don't seem like such a short deal. Are we going to get a weather scare? Yeah, we're going to get a weather scare. We always do. Everybody gets nervous. As Don pointed out, the market's been short. It's not going to happen until this summer. There's plenty of corn to go around. 90 million is still plenty of acres. And if you figure that we're usually off by an absolute value of about 1 million acres between March and January, as Elaine said, we're probably going to be close to 91 when all's said and done.
Okay. All right.
You know, I just want to follow up what Darren was saying, you know, because I do agree with him. I think the stocks are a huge thing, and who owns the stocks? As of March 1, the producer had 5 billion bushels. The commercials had 3.7 billion. So, you know, the producers out here are, you know, undersold. There's no doubt about it. Probably oversold on soybeans just from the price standpoint.
Okay. All right. Is this a time to be marketing some of those old crop corn bushels? Final question on the corn market. No? Naomi, hang on to them?
I would wait. I agree in the short term. We probably stay in a little bit of a range here. On those rallies, a lot of producers are going to be clearing out bins, and we see the market be trapped for a little while. So I would say sell if you need to sell, but if you can hold back, I would hold back and I would wait a little bit. But be aggressive and pull the trigger when the market gives you that opportunity, because that 450 resistance area is huge. It has been the high for the past 2 years.
Okay. Anybody with a contrarian opinion on old crop corn? All right, hold it. New crop? We'll see. Let's talk soybeans. Speaking of we'll see, bean market. Let's talk quarterly stocks report. Darren, anything jump out at you on the quarterly stocks?
Yeah, same situation we saw with corn. From first 6 months of the marketing year, demand's great, demand's great, demand's great. We came up a little short. Quarterly stocks were a little bit bigger than what they thought. First half demand wasn't quite as strong. We're going to add a little bit if this works its way out through the second half of the marketing year to a little bit bigger ending stocks number, 460, 470. That's pretty large. Could be around 440, 450. I'm having trouble remembering exactly what the numbers were. You carry that forward into next year, and all of a sudden your beginning stocks quite cumbersome, and with the end-all be-all being prospective plantings at almost 90 million acres, 1.8 million acre difference between absolute value difference between March and January, 91, or go the other way, 88. So a lot to happen in new crop, but it was a little disappointing looking at the old crop quarterly stocks number. I think it's going to be a bit of a concern, particularly since we're in that seasonal time frame where shipments start to slow down.
Right. And Elaine, that's one of the things that really jumped out on Friday watching the trade was old crop beans down 17 cents on the day. How much of that was quarterly stocks fear, and how much of that was quarterly stocks plus, oh boy, and Brazil's coming online with another big crop?
Yeah, this definitely goes to the point of the quarterly stocks report being a real data that actually means something versus prospective plantings being, something that doesn't really mean anything 4 weeks after the survey was done. And prices have changed 80 cents in the soybean market since that happened. So quarterly stocks wise, that's definitely what spooked the market today. And absolutely, we always expect to see double-digit gains and lots of volatility on March 31st. And the only market that really delivered that today was the old crop soybeans. The new crop really stayed in there.
They weren't double-digit gains, though, Nate.
No, they weren't double-digit gains. But it was definitely the old crop ending stocks number that was moving stuff today.
Okay. Don.
And when you look at it, that stocks number on that, it really what we really said on that report is last year's soybean crop was understated. We had a negative residual. That's the surprising thing. You thought 52.2 bushels an acre was large. They're saying it's even larger.
It was bigger. Now let's look out at new crop, because a lot of producers, we were watching those $10 prices, and the question I guess to all of you is, did producers get a lot marketed? Did we see the farmer making sales north of $10? In your opinion?
I think they did. I think they forward contracted. I think they got a lot of pressure from their lenders to make sure they were doing it. So I think there was some aggressive forward contracting or just protecting just in case with puts type of action. Going forward with that new crop, it still can be a weather scenario. However, it would take a really bad weather scenario to get the market to rally. The yield would have to come in more like at 45 bushel to the acre, which would be substantially below recent trend line in order to see the market move. And with the confirmation of the larger crop in South America, as we've been talking, that's why we've already lost $1 off the market. So now that's priced in, and now Likely, I think we'll see a little bit more of a sideways trade action and then wait to see how our weather turns out for the summer. But I'm thankful that most producers were aggressive on forward contracting when they had that $10 price point.
Okay. Now, Darren, Naomi mentioned that we have seen this dollar move already. The market has started to digest this huge South American crop, very large potential North American crop. Are we done with this move to the downside in beans? Where's the floor when you look at it from a technical perspective?
We hit the next floor at 950 today. That floor is not going to hold. Most likely, the next target's down around 920. Then, actually it's 901, but let's just call it an even 9. Below that, you're starting to talk about the November 2015 low down in the 840, 850 range. Do I think it's going to get there? Not right now. Eventually, we posted a new 4-month low on the old crop on the market as a whole this month. That doesn't look good. Downtrend in the November soybean contract itself doesn't look good. A lot of weight on this market. Funds were still long going in. You got to get all them out before this thing can start to find some support.
So the question at the end of the day is, do I go ahead and market a fair amount of my insured bushels or my physical beans today and look to re-own it? Or do I wait for a weather scare, try to catch a pop on the board, market it then, and if I do that, do I bother re-owning it? Don Rose?
Well, I think when you look at the market, if you back up and look at the prices, we closed, on Friday about $9.55. A year ago after the report, we were about $9.25. So we still have premium over a year ago with bigger crops, bigger ending stocks, bigger supplies around the world. But, when you look at it, this is the wrong time of year to be bearish on the grain market. I mean, when you really look at it, we have weather scares ahead of us here. We're oversold now, deeply oversold. And, we saw what can happen with the corn today and the wheat. This thing's going to get out of position and we're going to see rallies and breaks. So I most definitely don't like selling a market on a hard break, oversold. There's opportunities as you move through the time. If you're forced to sell stuff, I'd re-own it with some options and look for better times.
Okay. Let's take a look at the livestock market. We had some excitement over the past 4 weeks in the live cattle trade. We had stories coming out of Brazil about the quality of their meat that has been exported. Are we through that? Has the market digested all of that information? Elaine Cupp.
Well, that was probably an overreaction. That those highs that we put in the live cattle market were probably an overreaction, even if it was just futures trade, headline-driven trade, perhaps. And we were talking a little bit before the show that seasonally the expectation will be that we do move lower. So I don't think it's going to fall out of bed and suddenly collapse, because I think there is strength in the retail beef market. I believe there's general strength, and packers are making money. Everybody's doing okay, so I'm not suddenly bearish, but probably that overreaction high of a couple of weeks ago is not going to be retested. Okay.
Darren, you're smirking. What are your thoughts?
Well, I'm always smirking, but I just love the way you phrased the question. Has the market digested the spoiled beef? The spoiled beef story. For some reason, that struck me as humorous. Technical point of view, looks to me like cattle, they want to go down a little bit on their weekly chart. They've tried to push up here a couple times. The support has come from the right side. We've come from the cash side. Maintaining that type of cash support is going to be pretty difficult in here for a while. You get the cash market to back off a little bit. I think the futures are going to follow, and charts are certainly leaning towards we could see the market come down a bit.
Okay. Come down a bit. Are we going to retest $96 on a break, Don?
Well, I think when you look at the market, let's look what the USDA says for the rest of the year. We're going to be 110 to 120. They haven't been exactly accurate on the cash market, but if you look at the big cycles of all these commodities, basically most of them have come down 50% from the top. Cattle, hogs, corn, beans. And I think what we really have found out about the commodity market, we found some kind of low on a lot of these things, whether it's the grain, the cattle, or what. But so cattle, 95 to $1 is probably the low end of the range. Seasonally, this isn't a time frame to be bullish on the cattle. You're probably going to break hard on the cash cattle and on the box beef, and we'll probably find some stability. But I'd look for a seasonal break into the summer.
All right. Naomi, I want to talk to you about feeder cattle. Are we just going to follow that live cattle lower? Is there any, we saw strength in corn, and yet feeders were up fairly substantially on Friday.
Yeah, I would say that the feeder market, from what I've been reading, is that most feel that the seasonal rally has come and gone, and that the market is going to also have a setback just like the fats. I agree with Elaine that I don't think that we see everything just crash and burn lower. If you look at continuous monthly charts for cattle, feeder cattle, What we did in the past week was we bumped up against this downtrending line that had held from the highs from a couple years ago. But yet we're not quite yet to a major horizontal support line, which on the fats would be at $1. And I think we're going to be trapped in a range for summer. We've got grilling season coming up. Demand is good and the economy is going all right. People are going to be grilling all sorts of proteins out there. So I think it's going to actually start to go into a quieter market for a little while.
Find a little bit of stability in here, trade the range.
For second quarter, I really feel that way, yeah.
Grilling all kinds of proteins. That leads us right into our next discussion, the lean hog market. We've seen this pervasive slight weakness in the lean hog trade. We're bringing more pork to the market. Darren, from a technical perspective, what are you watching here over the next 2 months?
Next couple months. Well, so far hogs and wheat have been in a pretty good race to see who can get to zero first. Looks like wheat's going to slow down. Hogs still have some pressure coming on them. But over the next couple months, if we look at the weekly chart, June contracts getting awfully close to what it looks like should be finally a low. So I would say we're going to start to build some support in here. I think we're going to see the cash market come back a little bit. I think you're going to see hogs, they may want to drift a little bit lower, but I don't think it's going to be by all that much. And I think we're going to find a floor in here. It's not going to just turn around and go screaming higher, but I think we're going to start to flatten this market out and start to build a little bit of a base.
All right. Elaine Kub, is there opportunity for exports in the pork market?
One hopes so, and certainly we should be looking at the dollar. As far as any sort of export market, we don't want the headwinds from the dollar, and it feels like the dollar came down, sort of overreacted upwards, through most of the first part of this year, and then underreacted downwards. It's stabilizing, so I think our cheap pork, our heavily supplied pork market should be able to find some export markets.
All right. Well, thank you so much to all of our panelists for presenting. We have Don Rose and Elaine Kub, and Darren Newsom and Naomi Bloom. Thank you all so much. That wraps up the broadcast portion of Market to Market, but we will keep the conversation going, including answering more of your questions during Market Plus, which is available on our website. We have a new offering for our online viewers. Go to youtube.com/Market to Market and subscribe today. You'll get notified when Market Plus and our feature stories are posted. Join us again next week as we look at how one-stop shopping is connecting growers and buyers. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.